Hello students. Under financial management, we are dealing with the topic called as taxation. The modern state has to create conditions of social upliftment and betterment. It has to provide social and economic justice to the masses. It has to promote economic development of the country. In modern times, the role of the state has become more intense and extensive. To perform all such tasks, the state needs funds. The study of monetary and credit resources of the state relates to the economics of public finance. Economics of public finance is concerned with process of raising and distributing of funds, thus public revenue and public expenditure. Basically, we have the financial operations of the government or public authority like local, state government and central government includes wings of public finance. Under public finance, we have three categories. One includes public revenues, the other is public expenditure, and the last one is public debt loans. The public revenues, it refers to the revenue or income of the public authorities. It includes all types of receipts, including gifts and donations. Sources of public revenue. There are two main sources of generating the public revenues. The first includes tax revenues. The other includes non-tax revenues. Tax revenues basically refers to the income received from various taxes. It is the main source of revenue to the government. The other non-tax revenues, which includes the other forms of taxes. For example, we have the fines, penalties, donations, fees, chits, license, fee, profit of government companies. To name few, like basically the word where it has been originated, the tax. It has been originated from the Latin word called as taxo, which means I estimate, which in turn is from tango, which means I touch. Is to impose a financial charge or other levy upon a taxpayer by a state or the functional equivalent of the state such that failure to pay is punishable by law. India has a well-developed tax structure with clearly demarcated authorities between central government, state government and the local bodies. Central government levies tax on income, customs duties, central excise or the service taxes. VAT, which is value added tax. Sales tax in states where VAT is not yet in force. Stamp duty, state excise, land revenues, tax on agriculture income and tax on professions are levied by the state government. Local bodies are empowered to levy tax on properties, octroi and for public utilities like water supply, drainage, etc. Tax may be defined as a compulsory contribution of wealth of a person or body of persons for the services of public authority. Taxpayers cannot claim any benefit from government for the payment of taxes. Taxes are compulsory contribution imposed by the government on its citizens to meet its general expenses incurred for the common goods without any corresponding benefit to the taxpayer. With the increasing public expenditure, the volume and range of taxation has increased. Taxation is the source of public revenue. It constitutes the largest share in the total revenue of the government. Taxation, imposing a tax and collecting revenue is the main objective of taxation. Basically, what is the need for taxation? Taxation has four main purposes or effects. They are the 4 R's. I mean revenue, redistribution, repricing and representation. We will see step by step what are these 4 R's. The first is revenue, as I have been mentioning. Revenue, which is the taxes raised money to spend on welfare. It is the most widely known function of taxation. The second is redistribution. Normally this means transferring wealth from the richer section of the society to the poorer section. The third purpose is repricing. Taxes are levied to address externalities. Tobacco is taxed to discourage smoking. The fourth consequential effect of taxation is representation. Now, what is this representation? Rulers, tax citizens and citizens demand accountability.
Madam, funds provided by taxation are used for?
Well, funds provided by taxation are used for expenditure on war, the enforcement of law and public order, protection of property, economic infrastructure like for roads, legal tenders, enforcement of contracts, public works, social engineering and the operation of government itself to provide scholarship, employment benefits, non-employment benefits and other things. Government always uses taxes to funds welfare and public services like for education. The education is they provide the scholarships, healthcare systems, pensions for elderly, unemployment. Management systems are also common public utilities like water, waste management. Government have different kinds of taxes which vary the tax rates. This is done to distribute the tax burden among individuals or class or the population involved in taxable limits. So, we have different, a nation's tax system is often a reflection of its communal values and the values of those in power. To create a system of taxation, a nation must make choices regarding the distribution of tax burden. Who will pay the taxes, how much they will pay the tax, how much taxes are to be collected, which needed to be spent on the welfare activities by the government. Now, let us see the basic characteristics of taxes. The basic characteristics of taxation is a tax is a compulsory contribution to the state from the citizens. It is a contribution for the general or common use and not for any specific or individual benefits. Tax is not the cost or the benefit received. A tax involves legal compulsion. Non-payment of tax is a punishable offence. Lastly, the taxation is a product of growing solidarity and a sense of common social obligation. Let us see the basic canons of taxation. Canons of taxation are the principles of taxation. The qualities which a tax should possess are described as canons of taxation. Canons refers to qualities of an isolated tax and not to the tax system as a whole. Canons relate to the good tax system and all kinds of taxes refers to the rate, amount and method of levy and collection of a tax. There are basically 4 canons of taxation. They are the canon of equality, the canon of certainty, the canon of convenience and the canon of economy. We would see each individually. The first one is the canon of equality. A good tax should serve the purpose of equality or justice. It should signify equality of sacrifice, not the amount of tax. The tax should be such that it should be paid according to the ability to pay. It means that rich should pay more and poor less, as farmers has more ability to pay than the latter. The burden of tax has to be distributed on the basis of their ability to pass on to the taxpayer. To achieve this canon of equality, the tax must be progressive. Now, the second one which we would include is the canon of certainty. The canon implies that the tax which an individual has to pay must be certain and not arbitrary. The tax of payment, means of payment, mode of payment, amount should be clear and certain to taxpayer well in advance, so that it becomes easier for an individual to pay the taxes, the exact revenue, how do we prepare the sound budget. So, an individual can always think around how do he plan according to the budget and pay the taxes. The other one includes is the canon of convenience. The timing of tax collection, its mode of receiving payment should be such that it is easy and convenient to the taxpayers. This will help the taxpayer to make payments when they have sufficient time or income. The last is the canon of economy. Each and every individual may not have enough time to pay, since because of we have globalization very easily possible because of internet facilities. Online payments are very much in demand these days. So, the modern concepts of canon of taxation, other than the 4 canons of taxation, we have the modern canons of taxation. Modern economists have added a few more canons of taxation, which includes canon of productivity, canon of elasticity, canon of simplicity. Canon of productivity. Taxes should bring sufficient revenue to the state. Taxation should be stimulated and productive activity or effort of the community. So, government should get more revenues, it should act as an incentive to production. If import duties are levied, they protect domestic industries, which is of very great this things. Since Modi always insists that we have a domestic industries which should always be in demand these days. Instead of always having the other, using the foreign goods, we should be more inclined towards the Swadeshi products. Stimulate infant industries. Canon of elasticity. Tax collection should be according to the prosperity of the country. Tax revenue of the state should correspondingly expand or contract according to the change in national income. As the national income changes, we need to expand or contract the taxation. It is regarded as an index of the efficiency and stability of the state. Tax should be flexible, elastic, it should change according to the requirement, necessity of the government. So, tax should not be rigid. It should vary and change according to the priority, convenience, national interest, vary according to the conditions. The last is canon of simplicity. The tax should be simple and intelligible so that the common man can understand it. There could be not many taxpayers who have an insight into the taxes. They could not very easily understand how do they pay their taxes. If it is simple, a common man can understand it and can calculate it. So, the calculation part also, many of them depend on many of the CAs and many of the other authorities who could help them to pay the taxes. So, if it is quite simple, it can very easily, every common man can calculate it and pay it. It should not be elaborate too. So, let us move on to the types of taxes. Basically, 4 types based on the sacrifice involved on the taxpayers. Proportional taxes. This proportional taxes means whatever the size of the basis, whether for income, property or commodity, the same rate or percentage of tax is charged. For example, if income is rupees 10,000, the tax to be paid is 300 rupees, which is 3%. The balance is 9,700. Equivalently moving further, if tax is 20,000 rupees, then the tax instead of 300, we would have 600, same 3%, the balance would be 19,400. More income, less amount of tax is paid, the less burden. The percentage of tax is increased with increase in income. If the income is 10,000, the tax is 300. If the income is 20,000, then the tax is 600. So, it is 3% of the total tax. The next one is regressive taxes. The burden is heavier on the poor than the richer. The taxes are outdated in the modern world now. For example, salt tax during the Britishers rule is felt heavier on the poor people because the consumption is more and more among the poorer compared to the rich. The next one is the opposite of this, which is digressive taxes. The burden is levied higher and higher on the rich than the poor. Taxes on high-end products. For example, the Mercedes car, they have to pay a high rate of taxes if it is on luxuries. So, who can afford luxuries? It could be definitely a richer person than a poorer. Then we have is the direct taxes and indirect taxes. Direct taxes are being paid entirely by the person, suppose X or Y, the individual who is dealing with it. For example, the income tax. Each individual calculate their tax individually. This is direct taxes. Direct taxes may be adjusted to the individual characteristics of the taxpayer. Indirect taxes are passed on to the other partially or wholly. For example, the house tax charged on rent. So, it is indirect, where the tenant is paying the rent, and who is indirectly paying the property tax? The owner of the house is paying the property tax to the government, which becomes an intermediary. So, that is how it is an indirect tax, irrespective of the circumstances of buyer or the seller. The next one is tax based on method of assessment. Assessment is nothing but the calculation. So, tax on commodities are levied on the basis of the method of assessment. Basically, this type is exclusively for commodities. They are specific taxes and ad valorem taxes. Specific taxes, taxes which are levied on specific qualities or attributes of goods are called specific taxes. Specific taxes are assessed on the basis of weight, number of volume of commodities. Specific tax on cloth, for instance, for example, a particular length of cloth like meter, at a specific rate we may charge 20 paisa per meter. So, it is specific per meter on a commodity called as cloth. So, we move on to the ad valorem taxes, taxes which are levied entirely on the basis of money, value of goods. Taxes are known as ad valorem taxes. Sales tax, for instance, on a commodity may be levied as some percentage on its selling prices. Specific taxes are easy to calculate and administer. Specific taxes are regressive on character, since the same tax is levied on different qualities of goods. Relatively higher burden falls on low quality, cheap goods which are consumed again by poor people. So, the ad valorem tax involves calculation of the value of goods, hence they are difficult, since the calculation becomes quite difficult. But ad valorem taxes are equitable in terms of incidence as they have the ability to pay is fulfilled. They generally fall heavier on the richer consumers, since they are in proportion to the prices. So, again here all the time we have to see, for example, if income is taxed on a formula of 5%, we always have a tax slab which is 0 to 50,000, 10%, 50,000 to 1 lakh, 15%. Over 1 lakh, a taxpayer with income of 1,75,000 would pay a total of rupees 18,750 in taxes. So, always these tax slabs are being changed from year to year. Every financial year it keeps changing. So, let us see what are the basic taxes which are imposed in India. India has a well developed tax structure with clearly demarcated authority between central, state and the local bodies. Central government levies tax on income except income on agricultural income, which the state government can levy. Customs duties, central excise and service taxes. Various tax levied in India are income tax, inherent tax, property tax, sales tax, excise duty on luxuries, general state tax on commodities, are taxes on imports, road tax, educational cess, professional tax, water and drainage cess. These can be classified as 3 categories. So, first we will just go each individually. Taxes on income are levied on personal, corporate income and capital gains, basically 3 categories. Personal income tax is imposed on the net income of the individual, whatever earnings, Hindu undivided family and unregistered firms. Agricultural income is not taxable, there is an exemption. Corporate income taxes. Corporate income taxes is levied on profits of companies. Capital gain tax, This tax is levied on gains on the sales, exchange or the transfer of capital assets. If the gain on capital assets exceeds certain specified limit, then capital gains tax is levied on it. Second one is taxes on property. Property tax is levied on properties of the families and companies. The taxes paid on property include estate duty, wealth tax and gift tax. Estate duty, it is levied on the property which is inherent by the heirs, which is the generations. While transferring the property, this tax is now abolished in India. Next is the wealth tax. This is levied on net wealth of undivided Hindu families. The tax is levied when the wealth of family exceeds the taxable limit specified by the government from time to time. It is a progressive tax on wealth. The last one is the gift tax. It is levied on gifts and donations made by the person. The tax is to be paid by the donor. The taxable limit is fixed by the government from time to time. We have seen the taxes on income, taxes on property. The last one is the taxes on commodity. Commodity taxation includes sales tax, excise duty and the custom duty. Sales tax is imposed on the number of commodities like the sales made. Sales tax is levied by the state and central government on the specified commodities for the two governments respectively, which is VAT, value added tax is the best example of state sales tax. Central sales tax is levied on some commodities and services. The excise duty. Excise duty is the tax on the commodities manufactured in the country, which is again Swadeshi. The impact on the tax is on the manufacturers who are to pay the taxes. The incidence of the tax is ultimately borne by the buyers of the commodities. So, always the buyer of the commodities also have to include the excise duty. The last one is the customs duty. It is levied on the imports and the exports. Export duty is levied on the goods exported to foreign buyers. The exporters has to bear the tax on his exports. Rates of export duty are announced from time to time by the government. Import duty is levied on the goods imported into the country by the importers. The importers has to pay the tax as per the rates fixed by the government from time to time. Let's move on to see how this income tax calculations are being done, how the tax is to be calculated. It's quite simpler. What is salary? So, we need to have a clarity on what is a salary. Income under heads of salary is defined as remuneration received by an individual for services rendered by him to undertake a contract, whether it is expressed or implied. According to Income Tax Act, there are following conditions where all such remunerations are chargeable to income tax: when due from the former employer or present employer, in the previous year whether paid or unpaid, when paid or allowed in the previous year by or on behalf of a former employer or present employer, though not due or before it becomes due, where arrears of salary is paid in the previous year by or on behalf of a former employer or present employer, if not charged to the tax in the period to which it relates. So, we have clearly seen what is salary. We move on now what income under head of salary. Under section 17 of the Income Tax Act 1961, there are following incomes which come under head of salary. They are salary, including advance salary, wages, fee, commissions, pensions, annuity, prerequisite, gratuity, annual bonus, income from PF, provident funds, leave encashments, allowance awards. These are to name few. Once you are clear what exactly is the salary, you should always be very clear about even what are the deductions from the salary income. Certain deductions are available while determining the taxable salary incomes, which includes standard deductions and professional tax. Professional tax which is paid is allowed as deductions. Arrears salary, if salary is received in arrears or in advance, it can be spread over the years to which it relates and be taxed accordingly as per section 89(1) of the Income Tax Act. Education cess is applicable, which is at the rate of 3% on income tax, inclusive of surcharge if there is any. A marginal relief may be provided to ensure that the additional IT payable, including surcharge on excess of income over 10 lakhs, is limited to an amount by which income is more than the mentioned amount. Agricultural income is always exempted from income tax. Now, we have basically simple 7 steps how do we calculate the income tax, which every common individual should know. The first step includes determine your gross income. What is gross income? Gross income is nothing but what is the monthly income into 12 months. So, monthly income into 12, that is the first step. The second step includes calculate your donations. Suppose it is charity amount if any. Donation here means the amount given to some organization as charity, which should be conformity with the income tax rule. So, that is the second step. Third step is calculate your savings. It includes all your savings and investments that are listed in the section under income tax rebate. The fourth step is assess your taxable income. Taxable income is gross income minus donations plus savings. So, both together, donations, charity plus savings, you should deduct it from gross income to arrive at your taxable income, which is step 1 minus step 2 and step 3. So, you should add step 2 and step 3, which is add your donations and savings to arrive at your and deduct it from your gross income to arrive at your taxable income. Isn't it quite simple? Calculating the income tax. Now that you have calculated your taxable income, you may refer to income tax slab. There is always a slab for that particular financial year for calculating the income tax. Step 6, add surcharge. Add a surcharge of 10% of your annual income to the income tax that you have calculated in the preceding steps. This step is not applicable in case the annual income falls below 10 lakhs. So, it should never fall below 10 lakhs. So, the next step would be adding the education cess. Make an addition of 3% of your taxable income as educational cess to the new income tax figure that have calculated in step 6 above. The figure reached is your final income tax.
Ma'am, every year the tax will be changed. So when and how we will get the information?
As the time value of money is increasing day by day. So, the rate of taxes, the slab rate also changes yearly. You can find this every year, it has been released at many places, but you can always find a book called as Reckoner. In the Reckoner, always you can check the slab and calculate the tax. Let us conclude what we have been dealt with. Taxation is a source of public revenue. It constitutes largest share in the total revenue of the government. The main objective of taxation is to collect revenues. There we have dealt with 4 canons of taxation. Taxes are classified in various ways on the basis of form, nature, aim and method of taxation. In India, 3 types of taxes are imposed. They are taxes on income, taxes on property and finally the taxes on commodity. Taxes are compulsory contribution imposed by the government on its citizens to meet its general expenses incurred for common goods without any corresponding benefit of the taxpayers. With increasing public expenditure, the volume and range of taxation has increased. Thank you.